All right, today we're going to dive in and demystify one of the absolute cornerstones of modern finance, the capital asset pricing model, or as you'll often hear it, CAPM. This model gives us a really powerful way to think about a huge question. What's the real connection between risk and the return you should expect? So let's get right into it. At the end of the day, every single investment decision you make boils down to this one question. It's not just about chasing the biggest returns, right? It's about making sure that the reward you're hoping for actually justifies the risk you're taking on. And the capital asset pricing model, well, it gives us a mathematical way to start solving that exact puzzle. So here's our game plan. We'll kick things off with that classic risk-return puzzle. Then we'll decode the only type of risk the market actually pays you to take. We'll introduce this thing called beta, which is our yardstick for that risk, and then we'll put all the pieces together into the CAPM formula. Finally, we'll see what this looks like in practice and get real about its limitations. Okay, first up, let's really nail down this fundamental trade-off, because this is what drives pretty much every financial decision. It's this constant balancing act, seeking higher returns while having to accept more uncertainty. A lot of times, we think of risk as just, the chance of losing money. But in finance, the definition is actually a little broader. Risk is any deviation from what you expected to happen, and that could be a good surprise or a bad one. It's really the uncertainty itself that defines risk. So here's the crucial idea. If you're going to take on more uncertainty, more of that potential deviation we just talked about, it only makes sense that you demand a higher potential reward to make it worth your while. This simple, rational concept is basically the engine that powers all financial markets. Okay, so higher risk means you should get a higher return. Makes sense. But the next big question is, what kind of risk are we even talking about? Because it turns out the market only compensates you for one very specific type. This slide lays it out perfectly. There are two main flavors of risk. Think of systematic risk as the tide that lifts or lowers all the boats in the harbor. It affects the entire market. Unsystematic risk, though, that's more like a leak in just one specific boat. It's unique to a single company or maybe one industry. And here are some real-world examples to make it stick. Systematic risks are those big picture things, like inflation, interest rate changes, or overall economic growth. No single company can really control those. Unsystematic risks are much more specific, like a sudden change in management, a new competitor popping up, or a factory shutdown. Now, this is a total game changer of an idea. Why? Well, because you can get rid of that company-specific, unsystemic risk just by diversifying. By not putting all your eggs in one basket. And since you can basically eliminate it for free, the market doesn't give you any extra return for holding it. You only get rewarded for bearing the risk that nobody can escape, that systematic, market-wide risk. So, if we only get paid for taking on systematic risk, we obviously need a way to measure it for any stock or any asset we're looking at. And that, my friends, is where beta comes in. Beta is our yardstick, plain and simple. It tells us how much a particular stock tends to zig and zag in relation to the overall market. And just to set a baseline, the market itself, say the S&P 500, is defined as having a beta of exactly 1. So how would we actually read this thing? Well, if an asset has a beta greater than 1, it's more volatile than the market. When the market goes up 10%, that stock might go up 15%. On the flip side, an asset with a beta less than 1 is less sensitive. If the market drops 10%, it might only dip 5%. It just quantifies how sensitive an asset is to those big market-wide forces. Okay, we have all the key building blocks now. We've got the risk-return trade-off. We know the difference between systematic and unsystematic risk, and we have our measurement tool, beta. It's finally time to put all the pieces together and introduce the star of the show, the capital asset pricing model. And there it is, the famous CAPM formula. Now, I know it might look a little intimidating with all the letters and symbols, but trust me, it's actually really elegant. It gives us a simple, clear relationship to figure out the return we should expect from any security, all based on the systematic risk it carries. So let's break it down piece by piece. First, over on the left, that R's, that's what we're solving for, the expected return of our security. Then on the right, our starting point, our baseline, is the risk-free rate. This is the return you could get with basically zero risk. Think of something like a government bond. All right, next up are a couple of familiar faces. First, we've got the beta of our specific security, that measure of its sensitivity to the market that we just talked about. Then we have the RM, the expected return of the entire market, which is just the average return of all the assets out there combined. Now, this last part in the parentheses is absolutely critical. It's called the market risk premium. You can think of it as the extra reward or premium that you get for being brave enough to invest in the market instead of just playing it safe with a risk-free investment. And what CAPM says is that your stock-specific risk premium is just its beta multiplied by this overall market premium. It's actually that simple. So that formula gives us a great theory for the expected return on any single asset. But how does this help us when we're trying to build a whole portfolio? To really get a handle on that, we need to be able to visualize this relationship between risk and return across all the possible combinations of assets out there. And this brings us to a really brilliant concept called the efficient frontier, pioneered by Nobel laureate Harry Markowitz. Just imagine you could plot every single possible portfolio based on its risk and its expected return. The efficient frontier is that curved line that connects all the best-in-class portfolios, the ones that give you the absolute most return for any given level of risk. Okay, so we have our curved efficient frontier, which only includes portfolios of risky stuff. But now we introduce a straight line called the capital market line, or CML. What the CML does is bring that risk-free asset into the mix. This lets us create portfolios just by blending one single optimal risky portfolio with some risk-free borrowing or lending, which gives us that straight line of possibilities. And this slide shows the theoretical sweet spot. It's that one single point where the straight capital market line just kisses the curved efficient frontier. That spot represents the absolute optimal portfolio of risky assets, often called the market portfolio. The theory says an investor could get any risk-return profile they want just by combining this one portfolio with the risk-free asset. Look, this is a beautiful and powerful framework. It's elegant. But, and this is a big but, like all models, it's built on a whole bunch of assumptions. And it's so important to understand the gap between a perfect model and the messy real world. CAPM is built on some pretty big assumptions. It assumes markets are perfectly efficient, that all investors are totally rational, that information is instant and free, and that things like taxes and transaction costs don't exist. Of course, you and I both know the real world is way, way messier than that. And that gap between the theory and reality is really the model's biggest limitation. So what's the big takeaway here? The capital asset pricing model gives us an essential framework, a map for thinking about risk and reward. It brilliantly explains why diversification is so important and how that systematic risk is what really drives the returns we expect. But we always have to remember that it's just that, a map. It simplifies reality to give us a sense of direction, but it can never perfectly predict the complex, messy, and ever-changing terrain of the actual market.